Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. This is a breakdown on SoFi. SoFi is one of the most popular stocks, and I've said in the past that it has somewhat of a cult following, and I generally that gives me like bad vibes. Like, y'all don't have to have people out here fighting for this company. It's kind of weird. Nobody's out here fighting for Apple or Microsoft, but it's people really fighting for SoFi, which makes me think something's going on here. Either it's something I don't understand or something ain't right. So I decided to take time to dig into it. Y'all asked for this as well, so I'm going to go ahead and give you my thoughts on it. And honestly, I found out some stuff about this company that I did not expect to see and think about. So I'll bring up all of that. Now, the purpose of this video is not to get you to buy or sell or to hold on to the stock. You do what you want to do. The purpose here is to show you what I look at and what are some of the things that I look at and notice immediately as I'm starting to evaluate a company. But also, the key thing that I want you to take away is how I'm putting the element of the company together with context. I am really, really big on context. And if you read my book, you also know that I talk about that in history as well. What I am looking at someone with an economics background is, number one, how is the company doing? I talk about all the time, but also, how is it doing in context and relativity to everything else, right? So if SoFi is down, which it is 75% in the last 6 months, okay, that's one thing. But also, what about its competitors? What about Robinhood? What about JP Morgan? How do these things play into it? What does it mean when interest rates are going up? What does it mean with the student loan pause? These are contextual things that looking at a chart is not going to tell you. By looking at an income statement is not going to tell you those things, at least not immediately. So I want to help you to combine those two things and help you to make a more informed decision. Because if I have more information, I really understand what's going on, I may react differently. I could say, hey, I understand what's going on. This student loan pause is going to do X, Y, and Z. That means I'm out of the stock. I need to leave today. Or it could be, hey, this thing is happening and I'm going to hold on, or I'm even going to buy more because I understand what is down the line between 2023 and 2024. Right? So it depends on the information that you have and how you interpret the information. So I'm just going to give you my high level interpretation. It will not be, we're not going line by line on every single thing in the financial statements, but I'll just give you the things I immediately noticed from it. All right. So I'll start off with what they do. Again, their stock symbol is SOFI. They went public in 2021 via SPAC, which is Special Purpose Acquisition Company. I've done videos on that, so feel free to go back and watch that so we don't spend too much time there. Now, the company was founded in 2011, so they've been around for a while, but they haven't been public. They haven't been accessible from a stock market perspective up until the last year or so. Now, on their statements, when they talk about what they do, it's actually really well written, which I think most are, but they help you to borrow, spend, save, and protect your money. That is what they do. Now, primarily, they make a good chunk of their money via financing loans. That is what they were before they started to branch into banking and investments, and we'll talk about that here in a few minutes. But essentially, home loans, personal loans, student loans. That's how they made their bones, really. And it wasn't until January of 2022 when they acquired a bank, and that was approved in February of 2022, which is good. That means that you are basically refinancing and loaning, and now you are becoming a real bank, which opens up the door to, one, more expenses and regulation. That could be a problem, but the other half is you can do more things. You can acquire more funds and do more things with that, which could be really, really interesting, but also kind of expensive. So we'll talk a little bit about that. And one of the most interesting things that I liked about SoFi, and I like about most companies, is I call it a company stack. Others call it vertical integration. It's really when your products can be looped into each other. And I'll bring up a graphic here in a second. And what they call it is the financial services productivity loop, and it sounds great. And basically it keeps you in the circle where you have content at the center, which I think is interesting because I create content, right? Is essentially they're educating you and helping you to understand, but really to move from one point to another on this wheel and keep your money growing with them. So for example, we talk about investing here. I do have a SoFi investing account. So let's say that you start investing, you're growing your money, and you say, look, maybe I need to take out a personal loan to pay off some debt, or take a personal loan to go buy something. I don't have a personal loan. I don't do those, but you get the point here. But I'm investing my money. I say, look, I need a personal loan. I got to do something. I open a credit card and start to improve my credit, and content really helps me to move and understand what's going on, and really quickly move to say, look, hey, maybe I want to buy a house. I've invested my money. I've grown my worth. My credit is good because I have a credit card from SoFi, and I got a personal loan from SoFi, and I'm managing my credit well. Boom. Now I'm getting a home loan. Now I want to pay out my student loan debt. All right, great. I can go right back to SoFi because I already got my credit card there. I already got my house here. I already got my investments here. Let me go ahead and refinance these student loans. Boom. All the money that I'm saving, maybe I just need to deposit it with SoFi so I can continue to grow my money and get a better interest rate than I would at, let's say, a JP Morgan. Boom. All this money that I've saved now, and all the money and the debt that I paid down with my high credit score, guess what? I'm going to go invest that money some more, and I'm right back where I started. And that is the purpose. That is what they want to do. Now, I call it the company stack, and the reason why I like it is because you want your products to keep people looped in, to, for better or worse terms, addicted to the service and addicted to the quality of what they sell and what they do. A great example is Apple and Google. You get an iPhone, it is married so well with the Mac, which I don't have. I have a Surface, but you'll get the point here. But it goes so well with the Mac, which goes so well with your Beats or your AirPods, which is just a perfect place for you to watch Apple TV. And you're paying Apple, 3 or 4 ways just by doing that. And every time it's a new one that comes out, you're going to get it because it matches everything else you got right out of the box. You don't even have to do that much. That's the point. That's one of the reasons why Apple is so very good at what they do. Google does something similar and I have a speaker, so I don't want to say the name too many times and it starts talking to me, but y'all get the point. From the speakers to the Android phones to their Google Buds to YouTube to Gmail, and y'all get the point here. It's a circle, it's a loop. And the problem with SoFi's financial services productivity loop is that they're not the only company that tries to do this, especially in the financial sector. As someone who worked at a bank, someone who worked and managed $140 million, I can guarantee you JP Morgan, Citi, Wells Fargo, Bank of America / Merrill Lynch, they all do this exact same thing. And to give you a little bit of background into what I did was that as I progressed through my career, that at one point I could only talk to people who only had $250,000 or more. If you didn't have that, you can talk to your boy. Okay, that's one of the reasons why I left, so I could talk to anybody I felt like it and talk about what I wanted when I wanted. Okay, so this is why I'm here. But essentially it was, you can only talk to people who have $250,000 or more. Well, how do you know that? I don't know. I can talk to the banker because they have a list of everybody and how much money they have. Right? I could also say, look, you got $2 million in your checking account. Maybe you can get more interest by doing X, Y, and Z. Come in, we'll talk. And then they say, hey, look, I'm considering buying a property. Oh, great. Let me pull over the mortgage banker person. So now you've already got a savings. Maybe you're investing some money. You might consider getting a home loan. We call that increasing wallet share. So what is the difference between JP Morgan and SoFi, Citigroup and SoFi? Why would I risk losing 75% with them? Well, I can do something like a JP Morgan that was down, at least when I looked at it, between 25 and 30%. They're both down, right? They're both down. But which one of those is going to be better for me? I can make arguments on either side. What SoFi is doing is technically not new, except for one tiny piece. But that's not new. Everybody tries to do that in some way or capacity, especially in the financial sector. When we talk about Robinhood, they're primarily investing now. Same thing with Coinbase, where it's primarily crypto now. I know Coinbase is going through some issues, but they all want to grow and do one main thing and then branch off and do others. I think SoFi is the best at it so far, but again, a lot of these legacy players have been doing it for quite some time. So That's just some context to consider, okay? And in competition that you should consider as well. Now, outside of home loans, personal loans, and student loans, they also do investing, which I did talk a little bit about, but they also have a tech platform that I think is really interesting. They classify this as trying to be the AWS of fintech, which means that they are technology platforms what other banks and other institutions use to run their financial platforms and to really build on top of that, which I think is really interesting, which basically says that SoFi doesn't have to be the largest bank. They don't have to be the best investing platform. They can just sell the technology to everybody else and help them to build whatever it is they want to build. So that's really interesting because AWS is similar. A lot of technology that people use to build on top of AWS makes them who they are. An example of this for those who aren't super technically inclined is I'm using YouTube's technology to build my program on top of that, to build my business on top of that, right? So I'm using YouTube's stuff to publish this stuff. So similar, one easy way to kind of understand what that really means, okay? All right, so that is what they do and how they kind of do it. Here's what you need to know, and here's the fundamental part of this that I did not necessarily know. So we know right now that SoFi, as of today, in the past year, over the past year, they're down 75%. That ain't good. Okay, that is not good by any stretch of the imagination. When I look at, I'm sorry, this is 75% in the last 6 months, so it's even worse. But over the past year, they're down 62%. Well, I compare that to the S&P 500, because remember, everything is down. Context is key. The entire stock market is down. The stock market, the S&P 500, last 6 months is down 15%, but it's only down 5% in the past year. We don't know where it's going, but that's just the context. 15% in the last 6 months for the stock market, 75% for SoFi. That's a problem. But just like I told y'all yesterday, the question is, are you still growing? And are you still acquiring people at what we call the top line? You're getting more money and more people at the top of the funnel. And is it something that's going to be permanent? Is it something that can resolve itself in time? Is there something happening in the economy that could change your fortunes? And is this a buy low moment where it's like, hey, look, I understand where you're at now. I believe in 2, 3, 4, 5 years, this has to improve. It is guaranteed to improve. So I'm going to go ahead and load up on shares now. Let's take a look. So if we go here, and you should be able to see this on the screen. This is SoFi's 2021 annual report. So it's as of December 2021. Now we'll talk a little bit about their quarterly results too, but I like to look at year to year to really give me a picture of what's going on. So first we're looking at interest income. That is basically how much they are making from the interest of the loans that they sell. I mean, that's what they do. It's where they make a lot of money from. So if I look here, starting in 2019, you made $570 million. And then 2021 and 2020, it just dropped off. What happened? Right? That was my immediate thing, is what happened? Until you start to look at context, which is why this is so extremely important. Well, you had the student loan pause. That did happen. And you had interest rates get cut across the board. That explains it to me, right? And we do know that in 2022, interest rates are going up, and that pause, whether it's a total forgiveness or it's 10,000, 50,000 or whatever point, that's the forgiveness thing is something you want to be aware of. It may not affect you as much since these are private loans. So that is one asterisk that you do want to understand the context of. But also, perhaps the money they're making from interest would increase over the next several years. That could be a thing, right? So they make money from interest on the loans. It was down the last 2 years, perhaps the next 2 or 3. I would expect that to increase in many ways, because they don't just do student loans, they do several other types of loans as well. So, yeah, so something to notice, right? That gives me hope. I'm optimistic here for the future in this case. So if I'm scrolling down here, I'm looking at non-interest income. So it's not from, as you can see here, not from just making interest, but like actually the fees on creating the loans and all that kind of stuff. Well, this has actually grown significantly. So I'm looking here, basically 300 million, 371 million, and then close to $500 million. So they're making more loans. You're actually growing, but you're not making as much on interest. Just interesting, okay? So it looks like, you know, there's some offsetting factors, but things are slowly progressing, at least in the last 3 years. If I go down here, this is net revenue. This is the total money you are bringing in. It is not your profit. So that profit is the money I brought in minus the expenses, which we'll talk about as well. But in terms of the total money that is being brought in here, it looks like they're making money. You started off, I don't know what kind of check mark that is. They had 442 million. Then we're looking at 565, and we're looking at close to $1 billion in revenue. That is not profit, but it is revenue. So interesting, you're making more money. More money is coming in. Then I'm going to go down here and skip to net loss. This would be net profit if they made money. They did not. So it looks like you lost 240 million, lost 224 million, and then you lost a lot of money here. So we are losing more money. What happened in 2021? That's something that I would look at. And I would also look at what expenses exploded perhaps in 2021 that threw everything off. Because you can see, right, that I made more money, right? I brought in more money, but I lost more money. So it has to be an expense that was pretty high. And just eyeballing it here and just quickly just looking, I see sales and marketing blew up, right? I went from 276 to 426. So that's one thing that was pretty high. And then also general and administrative costs also increased. So I want to see what that is. And is that something that is temporary, or is that something that's going to continue to rise in 2022? That's just a question. Okay. So right now, fundamentally, again, they're losing money. It happens. We knew that coming into it because it was a relatively new company and that they are trying to grow in this space. But they spent more. They spent significantly more in sales and marketing. Is that something that's going to continue, which they do need to do to acquire more people, which is working, by the way. And then that general and administrative cost, what is that and why? Are they hiring a lot of people? Again, questions that I would ask and things that I would dig into. But based on this, increasing revenue is good. Okay, that is good, and that is something that is encouraging. When it looks to the technology and marketing side of things, sales and marketing side of things, yes, you want to market, you want to be attractive to people, to bring people in, and it has worked. They have grown their consumer base significantly, and they are still growing to this day, which is still good. We have not seen something like a Netflix or even a Facebook periodically where they lost users, they lost subscribers. That's not the case for SoFi. They're still bringing in people. They're still increasing their revenue. At some point, because these are usually loans, once I'm in, I'm in. 30-year mortgage, I got to pay for 30 years once I sell the house. That's locked in to a degree, right? So that is good. On its face, that is good. So when we look at their quarterly results from the most recent quarter and talk about, well, what else is going on with the company that we should know about, and what does that mean for the company as a whole? So I'm going to quickly pull that up. And as you can see here, this is just from the quarter, or really, I'm sorry, from March of 2021 to March of 2022. Now, notice here that they still have a net loss, but that net loss did decrease from 177 million down to 110 million. That is a decrease. That's good. That the losses that you had piling up are starting to slow. Now, keep in mind that the periods are different here. Right, so it's not from this, January to December 2021, 2020, and 2022. This is just from March. So from March 31st, 1 year from that to March 31st of 2022. So that's why the numbers are slightly different. But from this period that we're looking at, they did decrease. We also saw a 69% increase in total revenue. You're telling me that you increase your revenue from this period 69%. And the company is down 75%. I'm sorry. That tells me that there is something good going on with SoFi, and that this 75% drop, you can call it a dip, this is a fall off a cliff if you ask me, that's something I got to look at. That is something I have to look at. And that is encouraging, because my view on the economy, and yes, we very well could be going into a recession, is number one, recession not going to last forever. That's number one. But also, you are still, even in this environment with inflation doing what it's doing, with interest rates going up, and student loans still being on pause at the current moment of this recording, it tells me that the future might be really bright for SoFi. Today is not great, but it could be really bright for SoFi over the next several years. Now, SoFi themselves say that they're not looking to hit profitability until 2024. When they do, it's really going to be on and popping at that point in time. So would I buy SoFi now? I don't know. It's hard for me to say that the current price of, I'm going to pull it up and look at it real quick. I think it's like $5 or so, which is really cheap. So the current price of $5, and depending on when you want to look at it, $5.60, $5.75, whatever it is the best price to get it at. That's hard because it is really, really close to penny stock territory, which things can be extremely, extremely volatile. If you were to get it at $5 a share and it drops down to $1 a share, you lost 80%. And that is possible because it's already down 75% just in the last 6 months. So it is really, really risky to try and time and get into a company like this. But as I said before, I like the stock. I'm sorry, I like the company. I'm not sure if I like the stock just yet. On paper, I understand why some people call this the next JP Morgan. I now understand why people say it's the most innovative company, the next Amazon, the whatever. Now, I can't sit here and tell you it's going to be the next Amazon. I don't like doing that because I don't know, right? None of us have a crystal ball. But I'll say this. Do I believe in the next 2 or 3 years that shares of SoFi are going to be worth more than $5 or $6 or whatever it is right now? I would say yes. And I think if you can stomach and be okay with this dropping to $1 or more, and if you got money that you can put into something and leave alone for 2 years or more, then yeah, you might be okay. You might be. But for me, I think the risk reward here is really, really high. You're already in a volatile market, and we don't know how far the market is going to continue to drop. And so long as that's the case, companies like SoFi are going to continue to suffer because they are going to have to borrow money. The cost of that borrowing is also going to rise. So I am curious to see where it goes. I'll keep my eye on it. I would invest in it if things were moving in the right direction, but it ain't. So you gotta really pay attention to it. So personally, I'm not comfortable investing in it, but I now understand that those who do, I get it. I get it. I apologize. I take back all my shade that I gave to people. Now, if you invested at $25 as of today, that don't look so hot. So you weigh that how you want to weigh that. But again, it's really, 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 really risky at this point in time. But they do, from my point of view, they have the fundamentals. They have the bones to be better than where they are right now. I don't think the company should be down 75%. I think in time, especially if I'm looking 2 to 5 years out, it can be worth at least 5 times more than what it is right now, which put it right back at $25, which is where it was like 6 months ago. Okay, so that's my thoughts on SoFi. If you like this breakdown, really let me know in the comments if this was enjoyable and easy to understand, and if it made sense and if it was valuable, because we've got some new options and toys to play with on this here YouTube channel, and this is y'all channel. Y'all told me to do SoFi, I'm doing SoFi. Y'all want me to do Amazon and Peloton? That's on the list. So we can make these exclusive videos for people who subscribe, and y'all can get these videos exclusive, maybe on a weekly basis or something like that. So you let me know what you think, and I'm going to do what y'all asked me to do. That's my job. All right. So that is it for me. I will talk to y'all tomorrow. Bye.